All right, welcome back to Asset Coach and Tax Strategist. I'm Robert Wolf, CEO and founder of Terra Firma Business and Financial Consultants, and we're continuing our series on financial distributors. So we talked about banks, investment companies, insurance companies, kind of a high level was our first episode. Second episode, we dove into what's an accredited investor and why that's important. And then last episode was we talked about banking, retail banking and consumer banking, or not consumer, but commercial banking and what that looked like. Okay. So today we're going to dive into the next part of our series. And again, we have no idea how long series is going to be. We're just diving into it, pouring into you. Keep in mind, before I continue on, this is just informational purposes only, right? We're not giving you any investment advice or telling you what you should do or you couldn't do or anything like that. We're just giving you content. That's what this purpose is content. So don't treat it as investment advice or Bob said I should do this. Go do your research, or if you're interested in becoming a member of Terra Firma, reach out to our team. We'll tell you, we'll go through the process, see if you qualify, all that fun stuff. But at the end of the day, let's dive into the content. Let's understand how does this pertain to us and what do we need to do moving forward. So we talked about retail banking. Now let's dive into investment companies. Now, again, we're still using Investopedia. My reasoning is that I want this content is all public information. It's out there, right? So just click on the link in the description and go to it. There's going to be a bunch of links. You can go dive into more detail if you want to on your own. But at the end of the day, the terminology of investment company and what it is, and then we'll dive into some more beyond this to understand what this basic foundation. So this is going to look familiar because that first episode that we did on financial distributors came right from here. Right from here. Okay. And it's, as you know, from that episode, it's a corporation or trust engaged in investing in pooled. Remember, this is our really important word that we're talking about. Pooled capital of investors in financial securities. Excuse me. So what we need to do is, as we go into the investment companies, investment companies are business entities. They're privately and publicly owned. Okay. So privately, you need to go to the Securities Exchange Commission and create private placement memorandums, PPM, private placement memorandum, based on regulations in sub-regulations on how you structure your private placement, whether it's for accredited investors only or accredited and non-accredited. There's a bunch that's important in there. And then publicly owned, also registered with the Securities Exchange Commission, and having to go through that process. The main business of an investment company is to hold and manage securities for investment purposes. That's it. Hold and manage for investment purposes. Now, they typically offer investors a variety of funds and investment services. Why? Because the more variety, the more money they can collect and manage, right? Which means the more they can earn in revenue. How do they make revenue? Fees, like all business. We don't need to go back through that like we did last episode, but let's click on portfolio management and see what that mean. What's it mean? Professional licensed portfolio managers. They manage these on clients based on the manager's goal and maximum investors expected return. Okay. And an appropriate level of risk exposure based on the expected return. Okay, that's important to understand. And so here's some different types of management. So there's active management, which is a strategy where portfolio managers actively buy and sell securities in an attempt to. So when they do this, they have a philosophy of what you're buying into, so to speak, as a philosophy. So I'm an investor. I'm going to give you money to invest on my behalf. I agree that your philosophy matches my philosophy matches your philosophy. Okay. So that's what I'm going to do. I'm gonna do that. And then they're gonna have algorithms, they're gonna have whatever they need to do to create that outcome of reaching that expectation of the mutual philosophies agreed. Okay. Now there's an excess return of an investment relative to its benchmark, which is alpha. Um, Asset allocation is a distribution of assets among different assets within a portfolio to preferred risk return profile. You're going to keep seeing this risk return, your portfolio. You're going to expected levels of risk exposure. Okay, there's a reason. Okay, this is for the public, non-accredited investors as well as accredited. But this information is not really for you as an accredited investor. It's important to know, but they're not concerned so much of you as they are non-accredited. So they need to make sure people understand. Okay, so asset class is a group of investments with similar characteristics. Okay, so stocks, bonds, real estate. So blue chip stocks, small cap stocks, bonds, REITs. These are all asset classes. A benchmark is a standard against which the performance and investment or portfolio is measured. Okay, so I find this hilarious. They use S&P 500 still. They still use S&P 500 as a benchmark when seven companies, the Magnificent Seven, it's so prominent that these seven companies have a title of the Magnificent Seven are the ones that are driving the rate of return on the S&P 500. Yes, they still match the 500 largest companies, those seven, but they're the ones that are driving the return. The other 493 are dragging the seven, basically, but they still use it as a benchmark. Drives me nuts. Same thing with the Dow, right? 30 stocks that change interchangeably based on a private company changing the Dow based on what they feel like are companies within our local economy. If you look at companies back in the Dow and when it first started, railroad companies. Oil companies. There's still a couple of oil companies, right? You had totally different. So we grade the Dow based on the current. So is it really at 42,000 or should it be even lower because you kicked out the bad performing ones that aren't relevant anymore and added new ones? I don't know. I personally think that's part of the manipulation of non-accredited investors, the retail investor. That's my opinion, right? So, but which is why they have all these terminologies and all this kind of stuff. But you got to know the game. You got to know, hey, if they're using the S&P 500 as an index as a benchmark, does it just make more sense for me to invest in those seven that are driving the rate of return? I don't know. I'm not saying to do that. I'm just saying it's hard to say you have 500 companies, but seven are driving it, right? And you consider that a benchmark. I don't know. It's crazy. A measure of investment volatility is what the beta is. Diversification. So what did we already talk about? We talked about asset allocation, right? Asset classes, diversification, risk tolerance, right? These are all terminology, spreading among different assets to lower the risk. Index fund, it's based on a performance of a specific market index. So if you do choose an index fund on the S&P 500, you are with utilizing the Magnificent Seven. Easy for you to say. So I don't know. Liquidity. This is important. I think this is important. Here's my opinion on liquidity. My opinion, Bob Wolf, that your overall investment portfolio, your personal plan should have liquidity off to the side. Not just your emergency fund, but your own cash equivalent liquidity. If you're putting money into an investment company, stocks, bonds, mutual funds, you're not putting it there for liquidity. You should have your own liquidity and you control your own liquidity. This should be, I'm earning a rate of return. Now, if they're using liquidity as a storage of cash to meet your assessed rate of return that you're trying to accomplish based on their algorithms and active money management, then okay. That's not really liquidity then. Okay. It's basically cash storage, right? Because it's going to be redeployed back into another asset. But my opinion, okay. Net asset value, passive management versus active management, portfolio optimization, rebalancing, risk tolerance, risk return trade off, Sharpe ratio, lots of terminology you should really click on and link and understand. Turnover. This is huge. I'm not a big fan of certain mutual fund managers that have high turnover. It creates a higher fee and cost within it. If it's an actively managed portfolio, then I get that. But if you're buying in a mutual fund and there's a lot of turnover, to me, that means the manager, and it's not an actively managed mutual fund, so to speak, then that manager doesn't understand what's happening too much because the turnover that's being caused. Why is there a lot of turnover? You have underperforming, you're getting rid of it to add performing, right? That's what turnover is, right? If everything was going well, you would have no turnover. Plain and simple, right? So this is something that I find that a lot of people don't look at that I personally think is very important. Okay. And then volatility. So, anyways, again, we're not giving investment advice here. This is all part of understanding the rules of investing. What's an individual investor? Okay, personal goals, risk preferences, resources, objectives, right? Risk tolerance, investment knowledge. Then you go to institutional investors, pooled large sums of money and on various financial instruments, pension funds, right? There's no risk tolerance conversation over here. No risk tolerance. They don't care about risk tolerance in large institutional investing. What's their goal? Long-term growth and sustainability over with short-term gains. Period. Boom, done. Do it. Right? So how do they do that? Understanding active versus passive. Hands-on approach where they're actively managed. Now, active manage could be a couple things. Could be an investment advisor, or it could be within actual portfolio of investments. Okay, and how you handle this. So this is to understand when things are active, there's going to be a higher cost because things are moving. There's more engagement versus passive. It's just set it and leave it. Don't touch it. And so those fees tend to be less. But if you have less fees, less return, and more risk, is that good? Versus I have less risk, more return, higher fees. At the end of the day, it's what's the net, right? What's the net that you're trying to accomplish? And does this match the rest of your investment portfolio or plan design, right? That needs to be understood. So many times when we have people that come to us, they have probably 80% of their assets sitting in investments in the stock market. And as we dialogue and talk with them, probably 90% of those don't even understand the stock market. They're actually scared and fearful of it, but they don't know where else to put their funds and their money. The other side is people have money in real estate and they do all these other things. They don't understand what real estate, they understand what these alternative assets are. They don't understand why they're doing what they're doing. They just feel like they're creating diversification, and so they feel better because not all their money is in one particular bucket. So, which I guess is good still, but you still got to look at the bottom line of everything that's happening, right? And why. And so that's important to understand. Active portfolio management, passive portfolio management. Again, it goes back to what I was saying is active and passive. Discretionary, non-discretionary management. Discretionary means that they can make these decisions on your behalf without asking your opinion. You've already signed that, hey, take care of it. Here, meet these criteria we talked about, do it. Non-discretionary is where they come up to you and say, oh, by the way, Bob, can we do this? Yeah, sounds good. Oh, Bob, we want to do this. Can we do this? Yeah, sounds good. Okay. They reach out to you each time to get your approval on that. Elements, portfolio management, asset allocation, diversification, rebalancing, tax efficiency. This is a bit of a joke, but tax efficiency, common portfolio, aggressive, conservative, moderate. This is important to understand. The difference between aggressive, conservative, moderate, income oriented. How does this meet your overall plan design? And why is that important? And tax efficiencies, I don't know. This is not so much they use Roth IRAs, but at the end of the day, what other tax efficiencies do you have? Um, understanding that, let's see, retirement security rule, ERISA. Anyways, so there's a ton of information, as you can see. A lot of it. We're not going through all of it in this episode. You're welcome. But this is something that's probably important for you to have a good understanding if this is an area that you're interested in, or you have money in this particular area. And things that I've said so far, you're like, I don't understand 30% of what you said. 40%. I don't understand anything you said, Bob. I didn't even know all of that existed. Whew. Well, you got some work to do. You got some work to do then. Okay. This is important. This is, people put money in these and trust advisors, and that's great, right? We have our own members that trust us, and we take that extremely. But one thing we tell all of our members every single time, this is your money. We treat all of them as non-discretionary. Every step we make, everything we do, even if they say, Bob, we trust you, just do it. Nope, 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 nope. This is your money. It's always your money 100% of the time. You hire us to do things on your behalf, to understand and have an expertise to bring it to you. Okay. That's it. We're not making decisions for you. Now, you make a decision and it's against what we think meets your criteria of what we've talked about. We'll tell you that's what you pay us for. That's what our members hire us for. We'll tell you why, but also here's what you can expect as a potential outcome of that decision, good and bad, and the steps we need or you need to take based on that good and bad because of that decision. Educated information to make an educated decision. Plain and simple. Sometimes we have members make different choices. Sometimes they're like, Bob, my gut just tells me I can't do that. Okay, that's fine. It's your money, not a big deal. Just know here's the outcomes, the positive and negative consequences, and the things that'll happen. Not a big deal, but here's how we can address that. Okay, lower expectations. We told you this. This is what's going to happen now. That's it. Not a big deal. Your money. I think that's very important. Very, very important to understand. So, anyways, I hope this is good. I hope you're enjoying this. I am. This is fun, but I could do this all day long with having nobody watch any of this stuff. I'm enjoying this. But if you're not a subscriber, just subscribe, right? What are you waiting for? Just subscribe, give us a thumbs up. Every Thursday we drop new episodes. If you're a physician and you're watching this and you haven't seen our Wealth Mavericks podcast or YouTube channel, go over there immediately. It's Wealth Mavericks, and it's talking all about physicians, how common questions that physicians have. It's geared to our main members, our physicians. Go over there. Physicians and business owners, go over there. Check it out. Subscribe. Get both of these channels. We drop episodes every Thursday, both of these. You have an entire week to watch and listen. Go binge watch and listen. Okay. But all this information is for you. Thanks so much. Make it a great day.